For most people, the buying and selling of cryptocurrency will be taxed as a capital gains transaction. However, if you can demonstrate that you actually run a business of buying and selling crypto, then separate tax rules may apply to you. So seek the help of a professional for that. Now, the appeal of crypto was that it was very decentralized. It's not government controlled. That's still the case, but now crypto platforms are sharing information with the Australian Tax Office. So if you're buying and selling cryptocurrency, it's likely that the tax office will have this information. So be really careful and make sure you include that when you're preparing your tax return. Now, capital gains tax can be good and it can be bad. If you make a loss on a crypto transaction, the bad thing is that a capital loss cannot reduce your taxable income. You have to carry forward that capital loss until you have a capital gain that you can offset it against. That's the bad thing about capital gains tax.
You suck!
However, the positive, if you make a capital gain, a capital profit on a transaction, and you have held that crypto asset for at least 12 months, then you may be eligible for a 50% capital gains tax discount, which is really, really good. And it simply means that you only include half of that gain in your taxable income. So you only get taxed on half that gain. Let's work through an example. Say you've bought $100 of crypto assets and you were charged a brokerage fee of $2. So your cost base in that is $102. You hold those crypto assets for longer than 12 months and you sell them for $112. Fairly simple, 112 minus 102 is a $10 profit. Check if you're eligible for the 50% capital gains tax discount. There are rules around which kind of taxpayers can apply for that. Generally, individuals are eligible as long as you've held that asset for longer than 12 months. So instead of including $10 in your income to be taxed, you only need to include $5 in your income to be taxed. That can be a really good incentive. Make sure you have the proper records to prove that that you held those investments for longer than 12 months. And let's do that example in reverse. Say you buy crypto for $110 plus $2 brokerage fee, so it's $112 is your cost, and then you later sell that crypto for $102. In that transaction, you've made a loss of $10 on that transaction, but you can't take that negative 10 to reduce your taxable income. Include it on your tax return and then carry that forward to future years where you may have another capital gain that you can use to offset that capital loss against. And you might be asking, what if you don't hold your crypto for longer than 12 months, so shorter than 12 months, and you sell it and you make a gain? Well, when you're not eligible for the 50% CGT discount, you just include the full gain in your taxable income. So you're paying tax on the full amount. And a capital loss never gets reduced. There's no discount on the capital loss. Whatever the capital loss is, that's the capital loss. What's key here is that cryptocurrency is a focus area of the tax office. You won't be able to hide your transactions. So make sure you keep all your documentation and include it in your tax return. Now, the next video in the series can be found right here. Keep in mind, I'm not a licensed tax advisor. This video is for educational purposes only, based on publicly available information. I've just packaged that information in an easy, digestible way for you. See you in the next video.